DHA account. 6 Option Strategy Chapter 1. Orientation Chapter 2. Bull Call Spread Chapter 3. Bull Put Spread Chapter 4. Call Ratio Back Spread Chapter 5. Bear Call Ladder Chapter 6. Synthetic Long and Arbitrage Chapter 7. Bear Put Spread Chapter 8. Bear Call Spread Chapter 9. Put Ratio Back Spread Chapter 10. The Long Straddle Chapter 11. The Short Straddle Chapter 12. The Long and Short Strangle Chapter 13. Max Pain and PCR Ratio. About. Open a ZERODHA account. Chapter 1. Orientation. 1.1 Setting the context. Before we start this module on option strategy, I would like to share with you a behavioral finance article one read couple of years ago. The article was titled Why Winning is Addictive. Here is the article. Authored by B. Venkatesh, a regular columnist for HBL. To buy and bet on a lottery ticket, a game that you typically avoid because you understand the odds of winning the jackpot is really low. However, if you do win the ticket, you will be most likely tempted to buy a lottery ticket regularly thereafter. We exhibit similar behavior when it comes to our investments as well. What drives such behavior? As humans, our life is governed by anticipation. So, looking forward to winning a lottery is exciting, and so is realizing that expectation. Research in neuroscience has, however, shown that anticipating a win is more exciting than actual winning. Nevertheless, once you experience the excitement of winning a lottery, you feel the need to indulge. That is, your brain compels you to buy a lottery ticket, even though you are aware of the odds of winning the second one. This happens because we tend to use more of reflexive brain than reflective brain. The reflective brain performs calculation that helps you analyze and think. The reflexive brain helps you feel and is more intuitive. When you feel an urge to buy a lottery ticket, it is your reflexive brain that is pushing you to do so. Your reflective brain is likely to tell you that the odds of winning the jackpot for the second time are low. Now consider trading in equity options. You know that buying calls and puts has its risk, as options often expire worthless. Yet we may choose to buy them regularly, especially if we have already experienced large gains from such investments. For it is the reflexive brain in action. With trading options, there is another factor at play. We know that options carry the risk of losing capital when our view on the underlying stock or the index turns wrong. The fact that we can lose money makes our experience of winning against such odds even more exciting. This is not so much true of lottery, because a lottery is a game of chance, while investments, we believe, require some degree of skill. End of article. You may be wondering why I chose to post the above article right at the beginning of this module. Well, this article echoes some of my own thoughts. In fact, it goes a step further to put things in the behavioral finance context. From the many interactions that I have had with both experienced and aspiring options traders, one point is quite common: most options traders treat options trading as a hit-or-miss kind of a trade. There is always a sense of amusement when one initiates an option trade. Many don't realize how fatal this naive amusement can be. Traders buy options month after month with a hope they would double their investment. Trading options with such a mindset is a perfect recipe for a P&L disaster. The bottom line is this: if you aspire to trade options, you need to do it the right way and follow the right approach. Else you can be rest assured the gambling attitude will eventually consume your entire trading capital, and you will end up having a short, self-destructive option trading career. I do have to mention this now, the common phrase that goes like this: WRT options, limited risk, unlimited profit potential, is a silent P&L killer. Newbie traders are disillusioned by this theoretically correct but practically disastrous fact, and thereby end up blowing up their books, slowly and steadily. Hence, I do believe that trading options blindly without a strategy is a dangerous but irresistible Pastime, smiley face, courtesy, Pink Floyd. I don't intend to scare you with this note. I'm only trying to set the context here. With the previous module on options theory, I'm sure you would have realized that unlike other topics in the markets, the science involved in options is heavy duty. It can be quite overwhelming. But you will have to trust me here. The only way to understand and master options trading is by structuring your learning path with a good judicious mix of theory and practice. In this module, I will attempt to give you a good overview of what you really need to know about some of the popular options strategies. Like always, I will try and stick to the practical aspect and ignore the unwanted and confusing theory part. As far as I'm aware, there are close to 475 options strategies out there in the public domain, and I'm sure at least another 100-odd strategies are hidden in the proprietary books of brokers, bankers, and traders. Given this, should you know all these strategies put up in the public domain? Answer is a simple no. 1.2 What should you know? You only need to know a handful of strategies, but you need to know them really well. Once you know these strategies, all you need to do is analyze the current state of markets, or the stock, and map it with the right option strategy from your strategy quiver. Keeping this in perspective, we will discuss certain strategies. Bullish strategies. Bull call spread. Bull put spread. Call ratio back spread. Bear call ladder. Call butterfly. Synthetic call. Straps. Bearish spreads. Bear call spread. Bear put spread. Bull put ladder. Put ratio back spread. Strip. Synthetic put. Neutral strategies. Long and short straddles. Long and short strangles. Long and short iron condor. Long and short butterfly box. Besides discussing the above strategies, I'd also intend to discuss Max Pain for option writing, some key observations and practical aspects. Volatility arbitrage employing dynamic delta hedging. The plan is to discuss one option strategy per chapter so that there is ample clarity about the strategy, without any mix-up or confusion. This means to say we will have roughly about 20 chapters in this module. Although I suppose each chapter would not be too lengthy. For each of the strategy I will discuss the background, implementation, payoff, break-even, and perhaps the right strikes to use considering the time to expiry. I'd also intend to share a working Excel model which would come handy if you intend to employ the strategy. Denote. While I will discuss all these strategies keeping the Nifty index as reference, you can use the same for any stock options. Now here is the most important thing I want you to be aware of. Do not expect a holy grail in this module. None of the strategies that we discuss here in the module is sure-shot money-making machine. In fact, nothing is in the markets. The objective here in this module is to ensure that we discuss few basic but important strategies. If you deploy them right, you can make money. Think about this way: if you have a nice car and drive it properly, you can use it to commute and ensure comfort of yourself and your family. However, if you are rash with the car, then it can be dangerous to you and everyone else around you. Likewise, these strategies make money if you use it right. If you don't, then they can create a hole in your P&L. My job here is to help you understand these strategies, help you learn how to drive the car, and I will also attempt to explain the best condition under which you can use these strategies. But making sure it works for you is in your control. This really depends on your discipline and reading of markets. Having said this, I'm reasonably certain your application of strategies will improve as and when you spend more quality time in the markets. So starting from the next chapter, we focus on the bullish strategies with the bull call spread making its debut. Stay tuned. 98 responses. Open a ZERODHA account. Chapter 2. Bull Call Spread. 2.1 Background. The spread strategies are some of the simplest option strategies that a trader can implement. Spreads are multi-leg strategies involving two or more options. When I say multi-leg strategies, it implies the strategy requires two or more option transactions. Spread strategy such as the bull call spread is best implemented when your outlook on the stock index is moderate and not really aggressive. For example, the outlook on a particular stock could be moderately bullish or moderately bearish. Some of the typical scenarios where your outlook can turn moderately bullish are outlined as below. Fundamental perspective: Reliance Industries is expected to make its Q3 quarterly results announcement. From the management's Q2 quarterly guidance, you know that the Q3 results are expected to be better than both Q2 and Q3 of last year. However, you do not know by how many basis points the results will be better. This is clearly the missing part of the puzzle. Given this, you expect the stock price to react positively to the result announcement. However, because the guidance was laid out in Q2, the market could have kind of factored in the news. This leads you to think that the stock can go up, but with a limited upside. Technical perspective: the stock that you are tracking has been in the downtrend for a while. So much so that it is at a 52-week low, testing the 200-day moving average, and also near a multi-year support. Given all this, there is a high probability that the stock could stage a relief rally. However, you are not completely bullish, as whatever said and done, the stock is still in a downtrend. Quantitative perspective: the stock is consistently trading between the first standard deviation, both ways, +1 SD and -1 SD, exhibiting a consistent mean reverting behavior. However, there has been a sudden decline in the stock price. So much so that the stock price is now at the second standard deviation. There is no fundamental reason backing the stock price decline. Hence, there is a good chance that the stock price could revert to mean. This makes you bullish on this stock. But the fact that there is a chance that it could spend more time near the second SD before reverting to mean caps your bullish outlook on the stock. The point here is your perspective could be developed from any theory, fundamental, technical, or quantitative, and you could find yourself in moderately bullish stance. In fact, this is true for a moderately bearish stance as well. In such a situation, you can simply invoke a spread strategy wherein you can set up option positions in such a way that you protect yourself on the downside in case you are proved wrong. The amount of profit that you make is also predefined, capped. As a trade-off for capping your profits, you get to participate in the market for a lesser cost. The third point could be a little confusing at this stage. You will get clarity on it as we proceed. 2.2 Strategy Notes. Amongst all the spread strategies, the bull call spread is the most popular one. The strategy comes handy when you have a moderately bullish view on the stock index. The bull call spread is a two-leg spread strategy traditionally involving a TM and OTM options. However, you can create the bull call spread using other strikes as well. To implement the bull call spread, buy one ATM call option, leg 1. Sell one OTM call option, leg 2. When you do this, ensure all strikes belong to the same expiry series. Each leg involves the same number of options. For example, date the 23rd of November 2015. Outlook, moderately bullish, expect the market to go higher, but the expiry around the corner could limit the upside. Nifty spot 7,846. ATM 7,800 CE. Premium 79 rupees per. OTM 7,900 CE. Premium 25 rupees per. Bull call spread. Trade setup. Buy 7,800 CE by paying 79 towards the premium. 7,800 CE by paying 79 towards the premium. Since money is going out of my account, this is a debit transaction. Sell 7,900 CE and receive 25 as premium. Since I receive money, this is a credit transaction. The net cash flow is the difference between the debit and credit, i.e. 79 to 25 equals 54. Generally speaking, in a bull call spread there is always a net debit. Hence the bull call spread is also referred to as a debit bull spread. After we initiate the trade, the market can move in any direction and expiry at any level. Therefore, let us take up a few scenarios to get a sense of what would happen to the bull call spread for different levels of expiry. Scenario 1: market expires at 7,700 below the lower strike price, i.e. ATM option. The value of the call options would depend upon its intrinsic value. If you recall from the previous module, the intrinsic value of a call option upon expiry is max 0. Spot strike. In case of 7800 CE, the intrinsic value would be max 0. 7700 7800 equals max 0 minus 100 equals 0. Since the 7800 ATM call option has 0 intrinsic value, we would lose the entire premium paid, i.e. 79 rupees per. The 7900 CE option also has 0 intrinsic value. But since we have written this option, we get to retain the premium of 25 rupees. So our net payoff from this would be minus 79 plus 25 equals 54. Denote: this is also the net debit of the overall strategy. Scenario 2: market expires at 7,800 at the lower strike price, i.e. the ATM option. I will skip the math here, but you need to know that both 7,800 and 7,900 would have 0 intrinsic value. Therefore, the net loss would be 54. Scenario 3: market expires at 7,900 at the higher strike price, i.e. the OTM option. The intrinsic value of the 7800 CE would be max 0. Spot strike equals max 0. 7900 7800 equals 100. Since we are long on this option by paying a premium of 79, we would make a profit of 100 to 79 equals 21. The intrinsic value of 7900 CE would be 0. Therefore, we get to retain the premium 25 rupees per. Net profit would be 21 plus 25 equals 46. Scenario 4: market expires at 8,000 above the higher strike price, i.e. the OTM option. Both the options would have a positive intrinsic value. 7800 CE would have an intrinsic value of 200, and the 7900 CE would have an intrinsic value of 100. On the 7800 CE, we would make 200 to 79 equals 121 in profit. And on the 7900 CE, we would lose 100 to 25 equals 75. The overall profit would be 121 to 75 equals 46. To summarize, market expiry LS/IVHS IV net payoff 7700 54, 7800 54, 7900 100 O plus 46, 8,200 100 plus 46. From this, two things should be clear to you. Irrespective of the down move in the market, the loss is restricted to 54 rupees. The maximum loss also happens to be the net debit of the strategy. The maximum profit is capped to 46. This also happens to be the difference between the spread and strategy's net debit. We can define the spread as spread equals difference between the higher and lower strike price. We can calculate the overall profitability of the strategy for any given expiry value. Here is a screenshot of the calculations that I made on the Excel sheet. LSIV, lower strike intrinsic value 7800 CE. ATM. PP, premium paid. LS payoff, lower strike payoff. HSIV, higher strike intrinsic value 7900 CE. OTM. PR, premium received. HS payoff, higher strike payoff. As you can notice, the loss is restricted to 54 rupees. And the profit is capped to 46. Given this, we can generalize the bull call spread to identify the max loss and max profit levels as bull call spread max loss equals net debit of the strategy. Net debit equals premium paid for lower strike, premium received for higher strike. Bull call spread max profit equals spread net debit. This is how the payoff diagram of the bull call spread looks like. There are 3 important points to note from the payoff diagram. The strategy makes a loss and Nifty expires below 7,800. However, the loss is restricted to 54 rupees. The break-even point where the strategy neither make a profit or loss is achieved when the market expires at 7,854, 7,800 plus 54. Therefore, we can generalize the break-even point for a bull call spread as lower strike plus net debit. The strategy makes money if the market moves above 7,854. However, the maximum profit achievable is 46 rupees, i.e. the difference between the strikes minus the net debit. 7900, 7800 equals 100. 100 to 54 equals 46. I suppose at this stage you may be wondering why anyone would choose to implement a bull call spread versus buying a plain vanilla call option. Well, the main reason is the reduced strategy cost. Do remember your outlook is moderately bullish. Given this, buying an OTM option is ruled out. If you were to buy the ATM option, you would have to pay 79 rupees as the option premium, and if the market proves you wrong, you stand to lose 79 rupees. However, by implementing a bull call spread, you reduce the overall cost to 54 rupees from 79 rupees. As a trade-off, you also cap your upside. In my view, this is a fair deal considering you are not aggressively bullish on the stock index. 2.3 Strike selection. How would you quantify moderately bullish, bearish? Would you consider a 5% move on Infosys as moderately bullish move? Or should it be 10% and above? What about the index such as Bank Nifty and Nifty 50? What about mid-cap stocks such as Yes Bank, Mindtree, Strides, Arcolab, etc.? Well, clearly there is no one-shoe-fits-all solution here. One can attempt to quantify the moderateness of the move by evaluating the stock index volatility. Based on volatility, I have devised a few rules. Works alright for me, you may want to improvise on it further. If the stock is highly volatile, then I would consider a move of 5 to 8% as moderate. However, if the stock is not very volatile, I would consider sub 5% as moderate. For indices, I would consider sub 5% as moderate. Now consider this, you have a moderately bullish view on Nifty 50, sub 5% move. Given this, which are the strikes to select for the bull call spread? Is the ATM plus OTM combo the best possible spread? The answer to this depends on good old theta. Here are a bunch of graphs that will help you identify the best possible strikes based on time to expiry. Before understanding the graphs above, a few things to note. Nifty spot is assumed to be at 8,000. Start of the series is defined as any time during the first 15 days of the series. End of the series is defined as any time during the last 15 days of the series. The bull call spread is optimized and the spread is created with 300 points difference. The thought here is that the market will move up moderately by about 3.75%, i.e. from 8,000 to 8,300. So considering the move and the time to expiry, the graphs above suggest. Graph 1, top left, you are at the start of the expiry series and you expect the move over the next 5 days. Then a bull spread with FAR OTM is most profitable, i.e. 8,600 lower strike long and 8,900 higher strike short. Graph 2, top right, you are at the start of the expiry series and you expect the move over the next 15 days. Then a bull spread with slightly OTM is most profitable, i.e. 8,200 and 8,500. Graph 3, bottom left, you are at the start of the expiry series and you expect the move in 25 days. Then a bull spread with ATM is most profitable, i.e. 8,000 and 8,300. It is also interesting to note that the strikes above 8,200 OTM options make a loss. Graph 4, bottom right, you are at the start of the expiry series and you expect the move to occur by expiry. Then a bull spread with ATM is most profitable, i.e. 8,000 and 8,300. Denote. The losses with OTM and FAR OTM options deepen. Here are another bunch of charts. The only difference is that for the same move, i.e. 3.75%, these charts suggest the best possible strikes to select assuming you are in the second half of the series. Graph 1, top left, if you expect a moderate move during the second half of the series, and you expect the move to happen within a day or two, then the best strikes to opt are FAR OTM, i.e. 8,600, lower strike long, and 8,900, higher strike short. Graph 2, top right, if you expect a moderate move during the second half of the series, and you expect the move to happen over the next 5 days, then the best strikes to opt are FAR OTM, i.e. 8,600, lower strike long, and 8,900, higher strike short. Denote. Both Graph 1 and 2 are suggesting the same strikes, but the profitability of the strategy reduces thanks to the effective theta. Graph 3, bottom right, if you expect a moderate move during the second half of the series, and you expect the move to happen over the next 10 days, then the best strikes to opt are slightly OTM, one strike away from ATM. Graph 4, bottom left, if you expect a moderate move during the second half of the series, and you expect the move to happen on expiry day, then the best strikes to opt are ATM, i.e. 8,000, lower strike long, and 8,300, higher strike short. Denote. FAR OTM options lose money even if the market moves up 2.3, creating spreads. Here is something you should know. Wider the spread, higher is the amount of money you can potentially make. But as a trade-off, the break-even also increases. To illustrate, today is the 28th of November, the first day of the December series. Nifty spot is at 7,883. Consider 3 different bull call spreads. Set 1 bull call spread with ITM and ATM strikes. Lower strike ITM. Long 7,700. Higher strike ATM. Short 7,800. Spread 7800, 7700 equals 100. Lower strike premium paid 296. Higher strike premium received 227. Net debit 296 to 227 equals 69. Max loss, same as net debit, 69. Max profit, spread, net debit 100 to 69 equals 31. Break even 7,700 plus 69 equals 7,769. Remarks: considering the outlook is moderately bullish, 7,769 break-even is easily achievable. However, the max profit is 31. Skewing the risk, 69 PTS to reward 31 PTS ratio. Set 2 bull call spread with ATM and OTM strikes, classic combo. Lower strike ATM. Long 7,800. Higher strike ATM. Short 7,900. Spread 7900, 7800 equals 100. Lower strike premium paid 227. Higher strike premium received 167. Net debit 227 to 167 equals 60. Max loss, same as net debit, 60. Max profit, spread, net debit 100 to 60 equals 40. Break even 7,800 plus 60 equals 7,860. Remarks: risk reward is better, but the break even is higher. Set 3 bull call spread with OTM and OTM strikes. Lower strike ATM. Long 7,900. Higher strike ATM. Short 8,000. Spread 8,000, 7900 equals 100. Lower strike premium paid 167. Higher strike premium received 116. Net debit 167 to 116 equals 51. Max loss, same as net debit, 51. Max profit, spread, net debit, 100 to 51 equals 49. Break even, 7,900 plus 51 equals 7,951. Remarks risk reward is attractive, but the break even is higher. So the point is that the risk reward changes based on the strikes that you choose. However, don't just let the risk reward dictate the strikes that you choose. Do note you can create a bulk call spread with two options. For example, buy 2 ATM options and sell 2 OTM options. Like other things in options trading, do consider the Greeks, theta in particular. I suppose this chapter has laid a foundation for understanding basic spreads. Going forward, I will assume you are familiar with what a moderately bullish, bearish move would mean. Hence, I would probably start directly with the strategy notes. Key takeaways from this chapter. A moderate move would mean you expect a movement in the stock index, but the outlook is not too aggressive. One has to quantify moderate by evaluating the volatility of the stock index. Bulk call spread is a basic spread that you can set up when the outlook is moderately bullish. Classic bulk call spread involves buying a TM option and selling OTM option, all belonging to same expiry, same underlying, and equal quantity. The theta plays an important role in strike selection. The risk reward gets skewed based on the strikes you choose.